Hello everybody, welcome to this webinar about the characteristics of Aussie dollar, brought to you by OctaFX. OctaFX, an award-winning broker that has one of the lowest spreads in the industry. We'll begin with quick housekeeping, some disclaimers, a risk disclaimer. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. You should not invest money you cannot afford to lose. And a hypothetical trading disclaimer. Information in this webinar is provided as is and a general market commentary and does not constitute investment advice. A few quick words about myself. My name is Yohay Elam. I'm a Forex analyst. I used to be a retail trader as well as a computer programmer. I founded Forex Crunch back in 2008 and the focus is on fundamental analysis. Don't worry, we'll talk also about some technical stuff. So today on the agenda, we'll discuss the Australian dollar. First of all, as a classic risk currency. Second, we'll discuss its correlations with China and commodities. We'll continue with economic indicators to note. Each currency has its own specificities. We'll talk about housing, perhaps the next big thing in Australia. And then we'll finish off with the technical behavior of the Aussie dollar, which is usually quite positive, and we'll note a few things about that as well. Okay, so a classic risk currency. What does this mean? Australia has a relatively high interest rate. Okay, this means that in the past, before the crisis, it used to enjoy what was called the carry trade. People would lend cheap money, perhaps in Japanese yen or other currencies, and take a risk. Okay, but what was seen as a safe risk. Okay, placing the money in Australia where the interest rate was very high. In general, this kind of behavior continues when things are good. People take the risk and buy the Australian dollar. So when we have positive news about the world, about economic growth, it's good for the Australian dollar. And when we have negative issues, economic trouble or geopolitical issues, the Australian dollar is sold. Sometimes this has the strongest impact on the Australian dollar, regardless of domestic issues in Australia, positive, negative, or other things related to the dollar. Just the global mood. If it's positive for the Aussie. If it's negative for the Aussie. Okay, more things as a risk currency. Just a few examples. Good news can be the election of the French president recently, Emmanuel Macron, in a land far, far away from Australia. That also helped the Australian dollar rise. And bad news can be issues in the Middle East, also quite far off from Australia, but this can have an impact on the global mood, on the risk-taking atmosphere, and impact the Australian dollar. So Australia, despite being very far away from many of us, we're from Europe, from the United States, it's still well connected to the world, and money flows quite quickly. Okay, during the crisis, Australian dollar was quite confusing. This is not the situation now, luckily. When we had bad news from the United States, it meant global worries. Again, the negative mood. This helped this US dollar, which was then a safe haven currency. So the Australian dollar went down. Okay. Nowadays, when we have bad news from the United States, it's a weaker US dollar and hence a stronger Aussie US dollar. Okay, this is not the situation now. When we had good news, it was risk on, a party, the US dollar would fall. Luckily, this is not the situation now, but we have to remember that these kind of plays, it changes from time to time, and we should be aware that we can have this confusing kind of reaction because we had it in the past, and history can repeat itself. Okay, usually it doesn't repeat itself word by word, but it rhymes, as they say. Okay, so bad times may return. Let's move to the second topic, correlations with China. China is the second largest economy in the world, and for Australia, it's the number one trading partner. Australia is sometimes seen, the Australian dollar, as a proxy to trading China, because the Chinese yuan is more or less pegged to the US dollar, or trades hand in hand, if you wish. So if you want to trade the ups and downs of the Chinese economy, second largest in the world, you trade the Australian dollar. China is responsible for 25 years without a recession for Australia. Very rare occasion where such big country, developed country, Australia, enjoys no recession thanks to the mining boom. China had its demand in metals, in iron ore, in copper, and also other metals that Australia exports. Australia also exports liquefied natural gas, and it powered the Chinese growth in houses and everything. And now Chinese demand is coming back to Australia. Wealthy Chinese people are buying homes in the land down under. Let's talk a bit more about metals. You probably heard this before, reference to Dr. Copper. Copper, very useful metal in so many things. People say that when, it best reflects the direction of the global economy. Sometimes called doctor because it has a PhD in economics. I don't believe it's that smart, at least not now. Maybe in the past it used to be. But for Australia, iron ore, the price of iron, is a better proxy. So we have a better correlation with the price of iron than with the price of copper. Correlations are a bit fading, more about copper, less about iron, but we have changes. In general, China is trying to diversify away from manufacturing, from investment, from building too many homes, too many factories, to more consumption, more services. But this new wealth, this new consumption can reach the shores of Australia as well. Housing, that's what we're talking about right now. So Chinese wealthy or middle class are buying more and more Australian property. They're escaping pollution in China, and they have more money to spend thanks to the boom of the Chinese economy. And it's reshaping the Australian dollar, Chinese yuan, or Australian-Chinese correlation. Okay, as with correlations, other correlations, it can be problematic. You cannot always rely on these correlations to trade. Okay, let's move to another topic, to the indicators that move the Australian dollar. When you're trading the news on the Aussie dollar, you should look also at Chinese indicators, because again, the correlations, despite some of them fading with metals, they're still strong. We still have correlation between the Australian dollar and Chinese events. So in general, when we have Chinese indicators, the Australian dollar has the biggest response, more than the US dollar, Canadian dollar, any other, the euro, the pound, any other currency. When they're released at the same time, Australian and Chinese figures, the Chinese ones tend to have the upper hand. Again, correlations can change, reactions can change, but this one is quite consistent. We sometimes have releases at the exact same time, sometimes it's 15 minutes difference, then we have better reaction to the Chinese ones. The most important indicators in China are GDP, clearly, it's released together with industrial output, and when we don't have GDP, because GDP is released only once per quarter, we have industrial output in China, which reflects Chinese demand for Australian metals. Okay, another figure is a forward-looking one and an independent measure, not produced by the Chinese government, but by an independent organization, Caixin. The Chinese Caixin PMI, especially for the manufacturing sector, has a significant impact on the Australian dollar, released at the beginning of the month. Okay, and of course, changes to Chinese monetary policy. If they raise interest rates, lower interest rates in China, change the reserve ratio, or come out with a statement positive about the Chinese economy, that's good for the Aussie dollar. Negative, it's bad for the Australian dollar. Okay, so if you're trading the Australian dollar, trading the news, China remains fundamental. Let's move to Australian indicators. So in general, in Australia, we have fewer indicators than in other countries. In the United States, they love economic data and statistics in general. Also in the UK, we have quite a bit, also in the Eurozone. In Australia, we have relatively less. GDP, for example, is released once a quarter, but only once. In the United States, we have revisions. In the UK, we have revisions. In the Eurozone, we also have revisions. Okay. Also, inflation figures, the consumer price index and the producer price index, are released only once per quarter. That's it, not every month like most of the world. However, on the other hand, the Reserve Bank of Australia, the central bank, meets every month except January when it's summer in Australia, but they meet every month. Other central banks, it's a bit less frequent, more like 8 times a year. Okay, so we have a central bank in Australia, the Reserve Bank, has a bit more weight in comparison to economic indicators. The impact of economic indicators released either by China or by Australia can have a longer impact. One of the reasons is their scarcity. Okay, there are fewer indicators, so they have a longer impact. The initial impact is, of course, in Asia, in the Asian time zone, on the Australian morning when the data are released, and then in Europe. And it can go on for a few more sessions, released in Asia, so we have an impact during the Australian session, Tokyo session, then European session, then the US session, and for another day perhaps or two. Another indicator which is quite important in Australia, and you will probably not hear about it elsewhere, is capital expenditure, or in short, CAPEX. It is closely watched by the RBA, and if the RBA says it's important, that means it moves the Australian dollar. Okay, let's move to our fourth topic in our characteristics of the Australian dollar: housing. Prices are high in Sydney and in Melbourne, the two biggest cities in Australia, and there are worries about a bubble, but they exist for quite a long time. It's fueled by a strong economy, which is makes it logical to see prices rise when the economy is strong. A strong economy, of course, is in Australia and in China, because Chinese buyers also push prices higher. Housing can crash the economy. We've seen that. It seems like a long time ago, perhaps. For some it just feels like yesterday. The big crash of 2007, 8, 9, 10. Housing can crash the economy, so if it goes too far to the upside, there's a higher chance of a big crash. And a crash in this specific sector in housing can mean devastation for the rest. Of course, the RBA, the Reserve Bank of Australia, is fully aware of it. What they're trying to do is use what's called macroprudential tools, or in simpler words, just limiting mortgages. So not everybody can take a mortgage. The down payment needs to be higher. Other kinds of limitations that are not interest rate changes. Okay, limits to foreign buying. And if we have more macroprudential tools, it substitutes hikes in the interest rate. So the Reserve Bank of Australia wants to limit a bubble in the housing sector. Instead of raising rates to make mortgages more expensive, it has these other tools. So if it doesn't need to raise rates, it can keep them relatively low, and that can weaken the Australian dollar, of course. And it lowers the chances of a crash if we have a Reserve Bank that is aware of the issue and tries to fight it. Well, we'll see how successful they are. Okay, enough about fundamentals. Let's talk about technicals. The Australian dollar in general consistently enjoys a more predictable technical behavior. I publish every quarter a report about the most predictable currencies, and the Aussie dollar is not always tops the list, but is always there. It's quite predictable. It enjoys a rising trading volume. It means it's also a bit more predictable, less air pockets, less times of low liquidity or low volume. It's becoming more popular. Trading Aussie dollar against the US dollar surpassed dollar against the Swiss franc. Swiss franc used to be more important in the past. Okay, it's the leader in commodity currencies. We have the Australian, Canadian, and New Zealand dollar, each one with its own commodities, and the Australian dollar is the best of its class of these risk currencies. More about technical behavior. The behavior is better when the Australian dollar is in trend, when it's rising. Now we're talking, we've seen a move to the upside in the past week or so. This is an example, but in general, when it's better when it is in trend rather than when it is in range. And it respects parallel channels. So when we see the Australian dollar moving, let's say now, for instance, to the upside, and we see trading in this parallel channel, making its way up, setting higher highs and higher lows, and these are consistent. These kind of parallel channels are they work well if you trade it. Usually, of course, nothing is guaranteed, but in general the behavior is better. It is a bit more choppy with support and resistance lines, so again, better with these kind of trends, these moves to the upside or to the downside. And the rising volatility, the more it moves, the more predictable it comes. Rising volatility should help. Okay, so we've come to the end of this webinar about Aussie dollar against the US dollar. Here are the conclusions, the top points we've talked about. In general, the Australian dollar rises with the global mood, with iron, with stocks. When everybody's happy, the Australian dollar enjoys momentum, and it falls, of course, when everything is negative. When stocks fall, prices of commodities fall, and the mood is negative. China, the world's second largest economy and Australia's #1 trading partner, still has a very strong impact. And we talked about indicators, how when we have at the same time Australian and Chinese indicators can have the upper hand. And China has an impact also on housing. So it's not only Chinese demand for Australian metals to build in China, but also demand from Chinese to buy property in Australia. This is a growing thing which will be more influential in the coming years. There are relatively few economic indicators in Australia, but they have a longer impact. So we talked about GDP released only once, and the same with inflation figures. And we concluded with its good technical behavior, thanks to rising volume, better when it's in trend, better in parallel channels than when it is in range. Okay, so thank you very much everybody for coming, for watching. Comments and feedback are always welcome, and hope to see you soon in our next webinar. And that's it. Thank you, safe trading, and goodbye.